What's up, everybody? Today we're going to be going over IPOs and why I believe that investing in them within the first 6 months to a year is usually not a good idea. So the first one we're going to start off with is one of my stocks, which is Corsair Gaming, okay? And in this example, Corsair is up since it IPO'd at $14 in September of last year, and right now it's trading at 33, which is a decent move up, okay? But the thing is, there's two reasons that I don't think you should invest in IPOs at the beginning. Number one is the fact that most of the time, the valuations that these companies get initially are way too high for what they're doing. And so investors are usually buying into a company that's overvalued. Number two is the fact that the insiders of the company are able to sell off their positions in the company after the lockup period, after the lockup expires, which is usually about 6 months to a year. And that's why I think almost every single IPO drops after that period. So in Corsair's example, we can see that it started out at 15, it went all the way up to 51, okay? Then this lockup expiration was like 2 weeks ago, and so it bottomed out at around $30 a share. But this is one of the only examples where you see this. Okay, we're gonna look at some other stocks now. Let's do Uber. So I'm gonna pick out some of just the biggest IPOs of the last year or two, okay? Here is Uber. They IPO'd in May of 2019, okay, at $41 a share. And as you can see, over the next year or two, the stock traded below its initial valuation. Another one is Lyft. Here we can see a similar thing. It's just almost 2 years later, it's just starting to get back to its IPO valuation, okay? Let's see, another one would be Levi's. See, so this one IPO'd 2019 at $17 a share, skyrocketed to $23 a share, and then for the next 2 years, it traded below that valuation, and now it's just starting to come back to that. So the point of the story pretty much is you're going to get a chance to buy that stock almost 99% of the time at a cheaper valuation than where it initially starts at. So let's go through some more. Let's do Airbnb. Here's another one. This is an interesting one too, because this one just IPO'd a couple months ago. And so it skyrocketed. It's been going up the last couple months, went all the way up to $216 a share. Now it's $188. But the thing with this is this company has not had its lockup period, the lockup expiration happen yet. I think it's supposed to happen, I think in June of this year. So we're going to see, I'm sure this stock's going to drop too, because not only that, but the market cap's $111 billion on this company. And as we can see here, let's look up Airbnb. So Airbnb, and this goes for the next stock we're going to look up too. So Airbnb has this huge valuation of over $100 billion on it, okay? However, they continue to lose money, okay? In 2020 is understandable because of COVID, but they still lost over $4 billion. That's a lot. 2019, they lost $674 million, okay? Now, long-term, I do see this company being, this is a cool company. Like Airbnb is, they have a nice business model, which, they can disrupt a lot of the hotel market share, but still, right now, probably not the best time to invest. Okay. Now our next one is Doordash. This is a very similar one because it IPO'd around the same time. A couple months ago of December 2020, it IPO'd at $189 a share. Then it went down to 140, bounced back up to 215, and now look where it's trading, 133, okay? Same thing with this one. The problem here is the valuation's way too high. And I think they do that because then any of the early investors, the insiders, then they can sell out at higher valuations to make more money. So DoorDash trading at a $42 billion valuation, and this company continues to lose money. 2020 was an amazing year because I worked for DoorDash. I knew how busy it was, and it was during the pandemic, it was the busiest they're ever going to get, and so they lost $500 million last year. So I mean, there's no reason for it to be trading at this high of a valuation. But this is another company that can be successful over the long term because they are the #1 player in the food delivery industry, and I don't see them going out of business. So let's see, what else do we have? Let's look up. Here's another one, Poshmark. This company went IPO in just a couple months ago, shot all the way up to $100 a share, and now it's 42, below where it IPO'd at. So there's another example. How about Pinterest? This is another interesting example too. So this one IPO'd at $19 a share around 2 years ago, and now it's 78. So this might be one of the only exceptions. After 2 years, the stock is actually up. So this one Pinterest has a $45 billion valuation. And let's see, as of 2020, this stock they're still losing money. So I mean, a lot of these new tech names they have huge valuations on them and they're unprofitable. So it doesn't make much sense. But as you can see, with the majority of stocks, they're valued too high when they IPO, and then after the lockup expiration, they usually fall. So just be careful with investing in any IPOs.